What's going on, guys? This is Lior and welcome back to my channel. Now, what I thought I would do in this video is actually show you behind the scenes of what goes on once I get a new property or deal under contract. Typically, there are a number of steps that I follow, including doing the due diligence, doing the underwriting, talking to lenders, and then talking to potential private investors. So there's 4 unique steps I usually take. So I thought I'd show you exactly what goes on in the background. I've got a deal under contract that I'm working on right now. It's a 6-unit property that I'm buying for $2.5 million. Yes, those are the numbers again. I'm in Boston. It's an expensive market. So I'll kind of show you how I'm breaking it down for this particular deal. And if you're doing a deal yourself, I'm sure this will help you out. So let's get at it. What's going on, guys? This is Lior and welcome back to my channel. Now, before I get into the meat of potatoes, first of all, if this is your first time on my channel, or if you haven't already done so, make sure you smash that subscribe button for me. Put out tons of new videos every single week where I give you guys project highlights, I give you guys behind the scenes views of my operations, my personal opinions on finances and real estate, and literally everything in between. So if that's the kind of content you're looking for, make sure you subscribe. So with that, let's hop literally right into it. So as I said, there are 4 key steps I take from the time I get a property under contract in order to kind of line up all my ducks, right? So I've got as I said, I had a property I just got under contract last week that I've been working on. The first thing I did once I got it under contract was the due diligence. And with due diligence, since this is a rental property I'm buying where I'm inheriting tenants, there's a couple of things I need to do, right? First of all, I got to review all existing leases for the property, right? So I asked the real estate broker, the listing agent, to get me all the information, including all the leases, if there's any Section 8 tenants, which in this case there was, to get some background on who the housing authorities are, what kind of vouchers they're on, just so I get a real good understanding of exactly what's going on with the tenants, who I'm inheriting, and so forth. Otherwise, there's really not too much else to do. I have to buy the property as is, and I did walk it with my GC, and it's pretty clean. I mean, I didn't have an inspection on it, but I've been doing this long enough where I know exactly what I need to look for. It looked pretty clean. I will have a construction budget here of $300,000, but nothing in my walkthrough with my contractor suggested that I'm heading for any issues. The building was definitely very well maintained by the owner, which is one of the reasons why I really liked it. There wasn't a ton of major deferred maintenance, just a lot of little stuff, cosmetics here and there, some small mechanical updates here and there, but nothing too crazy. So the second step I have to take is now properly finish the underwriting, right? So when I submit the offers, I kind of have my first filter, where I kind of make sure the deal checks out and everything looks pretty good. But once I get the deal under contract, I really just finalize those numbers on the underwriting, including the projections for my private investors, right? Because at this point, I'm going to have to start getting the capital raising process of the transaction going, right? So if you guys don't remember, when I buy deals, I actually get private investors who help me fund the deal, and then in return, they usually get a percentage of the project. I kind of have to tighten up my numbers for them to show them the projections. So as I'm talking about that, what I'm actually going to do right now is go to my computer, and I'll show you guys both my underwriting as well as all the docs I put together for the investors, so you guys can see exactly what I put together, how I structure it, as I begin to have my conversation. All right, so for my underwriting, I'm looking at my screen right here. What I like to do, like I said, is really tighten up, get a couple more scenarios in the Excel sheet, because when I talk to investors, I usually like to present them a couple of different scenarios, right? I usually have kind of low case for my projections, then I'll have a base case and an aggressive case, right? So as I look at my sheet here, basically what I did was I created a number of scenarios for different projections, including how long it's going to take us to stabilize the existing units, right? Because the existing units that we're inheriting, the existing tenants, are paying below market rent. So it's going to take some time to renegotiate with them their rents, or potentially negotiate some sort of cash for keys buyout. So I have a couple of scenarios where, I have one projection where it takes me about half a year to stabilize the building, another projection where it takes me closer to a year, just so I can show everyone, look, in my worst case scenario, this is how it plays out. If it kind of plays out the way I think it will, Here's what the numbers will look like. And then same thing also with rents, right? Especially since this is a value add apartment play. And a lot of my valuation on the back end is of course going to be dependent on my gross income. I have a couple of different scenarios where I have aggressive underwriting on the rents. I have kind of base case underwriting on rents. And then again, also a low case, right? Because I want to show them, look, if for whatever reason, maybe COVID is still an issue next year, once the building is fully stabilized and we're still not at 100% back to market values, this is what the cash flows and projections for the building will look like. Now, step number 3, which is important to have before step number 4, in my opinion, is what I like to do is then start having conversations with the bank, right? Because I want to really try to get some sort of term sheet from a local lender to understand, hey, what kind of terms am I going to be dealing with? Because the terms of the debt that you can get will really impact the deal, right? And in this particular situation, I actually got very, very attractive term sheet from a local lender. What I actually got was I got a commercial loan, right? So basically my percentage rate is about 4.25. I'm getting 75% leverage on the acquisition, 100% leverage on the construction. So I'm going to get the entire $300,000 in construction. But what's really cool too here is I'm getting a 24-month period, interest-only period, right? So basically I'm going to get 2 years of interest-only payments, which will give me more than enough time to kind of stabilize the building, turn over the tenants. Again, if I need to renegotiate rents, I'll renegotiate them. If I need to do buyouts, I'm going to buy them out. But it'll kind of take off a lot of pressure in stabilizing the building and getting all the units up to market rent. And based on these terms that I got from the lender, I'm able to plug them in into my debt assumptions on my model right here. Again, I'm looking at right now. And again, that of course impacts cash flows, right? Because interest-only payments, you can of course get much better yield, especially if you can stabilize that if I can stabilize that building the first, call it 8-12 months, then those next 12 months are going to have really, really nice yield, really, really nice cash flows, because again, my mortgage payments are going to be interest only. I won't be paying principal, so I can offer some more cash flows for my private investors. So now I move on to step number 4. Based on everything I have, right, including my underwriting of the different scenarios, now I have my debt assumptions, what kind of terms I'll be able to get from the bank. Now I'm going to move to the final step, which is finalizing investor returns and starting to have conversations with private investors, which is where I'm at right now, right? So basically what I put together is nice projections of what investors can expect if they invest in my deal, right? So basically I tell them, look, if you give me X amount of dollars, right, and my timeline is a 3-year timeline for all my deals, here's how much money you're going to get back at the sale. Here's how much cash flow you're going to get in the intermediary periods, right? Year 1, year 2, year 3. And that way they can make their decisions of whether this is an attractive deal for them, right? The main metrics I use to kind of describe those for the cash flow, of course, would be the cash on cash returns, right? So that's exactly how much cash flow they're returning on the invested money. And then for the total attractiveness of the deal, which includes both cash flows as well as return of principal and any profit on top of that, I use the IRR metric, which again is basically a time value sensitive metric, which takes into account all cash flows at the exact periods of time they're going to come in, and gives the investor essentially a time adjusted return metric on overall investment, right? That's kind of a high level way of explaining the IRR. Now that I have those two metrics kind of figured out for the investors, my next step, what I do is put together what I call essentially a memorandum of the deal, right? So I basically put together a deck explaining both the financial metrics behind the investment, right? So the cash flows, how much money they need to invest, how much money they're going to get at sale, plus the other stuff, right? Including why this deal. I like to explain the story behind the deal, why this particular location. So for example, this particular deal that I'm buying in is in one of the most amazing markets in Boston. It's right next to Harvard and MIT. So it's got absolute amazing economic base to it. There is a ton of construction going on around this property. There's like $1 billion development going on the neighborhood over, where they're going to be building commercial space, retail space, lab space. So I see a lot of growth opportunity for them, and that's what I'm going to explain in the deck, right? Just so everyone investing in the deal understands exactly what and understands why I'm so excited about the deal, why I think it's such a good opportunity. I mean, I am incredibly excited for this, if you couldn't tell. So that's what I'm putting together as my final step, and then kind of starting to have conversations with folks to see if it would be a good fit for them, both in terms of their investment strategy, in terms of returns, and if that's the sort of location and asset that they'd be looking to invest in. So hopefully that's helpful, guys. Hopefully that kind of gives you an overview of, as I put this down, it gives you an overview of what I do in between getting the deal under contract and then kind of, again, figuring out all the financials, the return metrics, talking to the bank, starting to have conversations with investors. This is a routine thing I do now with every single deal. Hopefully it gives you a little bit of insight what goes on behind the scenes when I do these deals. Of course, if you have any questions or anything like that, make sure you put those comments below.